Holy shit, yesterday was absolutely brutal on the markets. I mean, I don't know if you guys were watching the NASDAQ. The NASDAQ was down like 3 or 4%. But Tesla was down 15.43%. And now you can pick up Tesla at the same price that you could have picked up Tesla all the way back in 2020. I genuinely saw yesterday that people were really scared on the TradFi markets and also on Bitcoin. If you look at Bitcoin was down at 76,800. Altcoins got absolutely wrecked yesterday. I'm sure you guys know this because we're all altcoin degens. In fact, I read that this was the largest wipeout on all altcoins since the Lula collapse in May 2022. And I guess now the market's basically rationalized that this is part of Trump's big master plan to crash markets and to bring down interest rates so that they can refinance the debt. But the big question is, how much longer is this going to go? And how much more pain actually lies ahead? And I think I actually have the answer. So today I'm going to show you exactly how much longer this is going to go, why it's going to take that long to actually resolve, and how much longer and how much lower the markets are going to go. So listen, if that sounds good to you, you know what you need to do. You need to obliterate the like button. You need to subscribe to the channel. Let's get the show on the road, guys. Okay, I see some people are still confused about the time. We are starting earlier if you are in Europe, and the reason is because we follow American times and the Americans have moved their clock back. And since the Americans have moved their clock back, we are starting 1 hour earlier, which means that if you're in Europe, you need to be here 1 hour earlier. It means that if you're watching this as a pre-record now, in other words, you missed the live show because you arrived 1 hour late. No, guys. Until the 30th of March, when the European clock changes, we are 1 hour earlier. So remember to be here and tell your friends to be here and smash the like button and let me know that you're present in the chat. I do see everyone in the chat. I see Tinder, Killer Crypto. I see you guys all here. This is the time when you need to be here because this is the time where your fortunes are dictated. This is the time where the millionaires are made. I'm going to explain that to you in a couple of minutes. I'm going to actually show you what the different opportunities are and why this is exactly the time to actually be more engaged in the markets, not less engaged. I know a lot of people have disconnected, taking time off at this point in time. No, this is when you need to be buying. This is when you need. Don't buy when everyone goes euphoric. I think by now you realize that was a really bad strategy, right? You need to be buying when everyone's fearful. Now everyone's fearful. This is not the time to get disinterested. I'm going to show you exactly what I'm doing. So listen, if that sounds good to you, obliterate the like button. I'm going to get on with today's alpha. So I'm actually waiting for the NASDAQ to open. Let's just have a look here. Let's just quickly get the NASDAQ. Let's just see what's going on here because I'm waiting for the NASDAQ to open today. Yesterday was absolutely brutal. I haven't seen a day like that on the NASDAQ for a long time. I was specifically watching Tesla. And I actually landed up picking up a bag of Tesla at some point. And the reason why I picked up a bag of Tesla is because I missed Tesla in 2021. And now you can see that you can actually pick up Tesla at the same price that you could have picked it up just after COVID. So we're now we're back at December 2020 prices. And so I landed up actually buying Tesla. Tesla had an absolutely brutal day, 15% down. It was crazy. If you look at the Magnificent Seven and you look at the market cap losses on the Magnificent Seven, which is Amazon, Facebook, you know, the Magnificent Seven. Well, that was the biggest one-day loss for the Magnificent Seven ever. They lost nearly $1 trillion. $830 billion was actually lost in one day. It was absolutely brutal. Let's just quickly go and look at stocks like NVIDIA. NVIDIA was down. It is slightly back up. Meta, which had that 20-day winning streak. Remember that 20-day winning streak that Meta had? This one over here. Pretty much the entire 20-day winning streak has already been wiped out for Meta. So it was an absolute bloodbath, no matter which way you look at it. The S&P 500, that's gone back 9 months, 9 months of gains. So basically, if you look at where this is over here, we now go back all the way to July, 9 months ago. We go back to July 2024 on the S&P 500. You can also see that the S&P 500, if you take it from the top to where we are today, it's 10% down. But more importantly, it's broken through the 200-day moving average. So yesterday, it broke below and it closed below the 200-day moving average. You can see that in the TradFi markets, there is a lot of fear. You can see it in many places. You can see it, of course, in the Fear and Greed Index. It's now at extreme fear. It's been at extreme fear for quite a while now. You can see that the other place you can see it is the VIX, which is called the Volatility Index. If you look at the Volatility Index, the Volatility Index is at 28.54, which for TradFi markets means the markets are actually starting to get really, really, really panicked. So you've got absolute fear and greed in the markets. And the truth is that this is exactly what Trump wants. Trump wants there to be fear in the markets. And the reason why Trump wants there to be fear in the markets is because he needs to refinance the debt. And the problem with the refinancing of the debt is that the interest rates, the US interest rates right now, are too high to refinance debt. You've got US interest rates at 4.25 or 4.5%. That's too high to refinance the debt. And so as Adam Cochran actually says there, he says, Trump is crashing the markets to refinance the US debt. It's 4D chess. That's not how it works, he said. But the truth is, what we know is that Trump needs to refinance a whole lot of debt, which comes into maturity or which matures now. And the problem is that if he's refinancing it at 4.25%, it's simply going to cost the United States too much. And so what Trump is trying to do, he's trying to scare the markets. And through scaring the markets, he's trying to get Powell, he's trying to force Powell's hand to actually reduce rates. Now, I want to talk to you about how long this is actually going to last, because what Trump is actually achieving, what he wants to achieve. He's got everybody is scared. He's trying to force Powell's hand. He's trying to force Powell's hand into two things. One, he wants Powell to do quantitative easing. The second thing that he wants Powell to do is he wants Powell to reduce interest rates. Well, how do you achieve that? There are really two ways to get Powell to get into quantitative easing or to reduce interest rates. The first way is the COVID type way. And the problem with the COVID type way, in this COVID type way, the governments act really, really, really quickly because they have to act really, really quickly, right? And so what you typically get is a V-shaped recovery. And a very good example of this is COVID, right? So if you look at the COVID correction, this is COVID. This is the correction. We'll take it from the top, even though we know the COVID only started somewhere here, right? But we'll take it from the top. And you can see from the top to the bottom, it took about 22 days. So from the top of the markets to the absolute bottom of the markets, that took 3 weeks. More impressively, to get back to the same levels as the markets were, you're talking about 3.5 months. So in 105 days, which is just over 3 months, we got back to where we actually started before the COVID correction, right? Now, what you can see is that in this period, interest rates actually, let me see if I can get us a longer view here. So what you can see is in this period, interest rates moved from 2.5% on the 19th of June to pretty much zero by 1 year later. So it took 1 year for them to drop rates by 2.5%. Now remember that rates right now are about 4.5%. So here they dropped from 1.75% in February all the way to zero in one drop. So governments moved very, very, very quickly to stabilize the economy because something was breaking around COVID. And so what you get in that kind of scenario is you get a V-shaped recovery. So every time something breaks, if something breaks, the government has to act, and the government acts pretty quickly, and then you get a V-shaped recovery. The other way to force quantitative easing and to force interest rates to go down is, unfortunately, where something doesn't break. And if something doesn't break, then we get into a scenario where market participants need to be shaken out over a time and pain approach. So it's almost like a stamina approach. It is shaking out the people, the weak hands, but not shaking them out quickly with a big market correction. But it's more shaking them out through a combination of time and pain. And unfortunately, this is like, if you think about a patient that's got a Band-Aid or a bandage on a burn or something like that, right? So this approach is like actually peeling off the Band-Aid really, really, really slowly and waiting for the patient to capitulate versus just ripping off the Band-Aid. The first one is just ripping off the Band-Aid, and the other one is doing it really, 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 really slowly. That is unfortunately the path that we have to take now, because nothing in the economy is broken. And because nothing in the economy is actually broken, the only way to shake the market, to make the market really, really, really scared. And when I say really scared, I mean like so scared that manufacturers don't want to open a new plant. They don't want to spend the extra money. They don't want to take on the new jobs. You've got to get people so fearful that they're so scared about the future that they don't want to be spending anymore. They don't want to be stimulating the economy anymore. That is how scared you need market participants to be. Now, one way of doing it is to shut down the entire economy and tell everyone to stay at home. Okay, that'll make people scared, specifically when it happens for the first time. And that'll make people wonder. I don't know if you remember, but at COVID, we never knew how long the lockdowns would last. We thought we may never, ever get back to normality. That's the kind of fear that we're looking for. Now, the problem is that now we need to follow a time and pain approach, right? And the problem with that is that there's uncertainty for longer periods of time. So nothing breaks, and so confidence must be eroded over time. And in this case, the problem is that you're not going to get a V-shaped recovery if this happens, right? So you can see that, as I said to you before, with COVID, it was pretty quick. It was 105 days or 133 days from top back to top, right? And we reduced the interest rates very fast. Now we're going back to this time and this time-based approach. Now, the reality with this time-based approach is that the time-based approach requires certain indicators to trip, right? So in other words, how does this time-based approach work? Well, we're waiting for certain indicators to basically switch on or switch off. And I'll give you some examples of those indicators. The first indicator that we want switching on or switching off is we want fear. We want the markets genuinely scared. And to that end, I must say, we're pretty much getting some progress, right? Like, so if you look at like the Fear and Greed Index, this is a measure of the Economic Policy Uncertainty Index. And the reason why this is such an important measure is because when there's no certainty around economic policy, then people get scared and they don't invest, right? And so what you can see here, this is the Economic Policy Uncertainty Index, the 5-day average. And currently we're very high. This is caused by the tariffs and stuff like that. So all the tariffs, all the talk about the tariffs and the trade wars, this is making people uncertain. And so people are very scared to invest. And this makes investors scared. You can also see that the fear and greed is once again back at extreme fear, right? You can see that consumer confidence, we're watching this consumer confidence chart over here, which reports once every month. We want consumer confidence to drop by a lot, right? If we get a high drop in consumer confidence, then we know that the market's actually scared. So fear and greed already scared. The Economic Uncertainty Index already scared. So that's what we're looking at. That's the first indicator. The second indicator, which the market's looking for, is actually inflation, right? So remember that if we want Powell to reduce interest rates, he's looking for inflation and he's looking for unemployment. So let's look at where we're at with inflation, right? When it comes to inflation, we have a big reading tomorrow. The market is expecting 2.9% tomorrow. The Atlanta or the Cleveland Fed has told us that it's going to be about 2.83%, which is good. That's what we're expecting. The good thing, though, is that Trueflation is telling us that actually real inflation is 1.35%. And if Trueflation is telling us that real inflation is 1.35%, that means that in the next inflation reading, because Trueflation reads the data much more live than the government's reading data, which means that the readings are typically 1 month ahead when it comes to inflation, right? And so when it comes to inflation, Trueflation is telling us that in the next reading, not this one that's coming up now, not the Feb one, which we're reading in March, but that the next one is going to be about 1% lower. Okay, so tomorrow we've got an inflation reading. Everyone's expecting 2.9%. Hopefully we get to 2.9%. Everyone's like getting all excited about this, all nervous about this. But the next one is that because of this 45-day lead in April, the April CPI, the CPI inflation data will probably be quite low. So the first measure that you got is you got fear. The next one that you got inflation. Now, inflation is a monthly reading, and probably by April's CPI, which reports in May, we will start getting a significant decline in inflation. So now we're starting to paint a picture of how long this pain is going to last, right? Fear has already flipped. Inflation probably in May, so early May, when we read the reading for April, then we'll see the nuke in inflation. The next indicator is again a monthly indicator. So inflation is a monthly indicator. The next indicator is again a monthly indicator, and that's unemployment. Now we keep getting different unemployment readings. Some of it's in the jobs report, some of it's in the JOLTS data. The one that is super important for us is this thing called the real-time SARM rule recession indicator. The reason why this one is so important is because remember what Trump is trying to do, he's trying to engineer a recession. He's trying to make people really scared about the fact that there's going to be a recession. Because when there is a recession, or when a recession is imminent, companies generally don't want to invest. They're generally too scared to invest, right? And so remember that what Trump's trying to do now is he is trying to engineer a recession. And in order for it to be a recession, people use this indicator called the SARM recession indicator. And this indicator suggests the start of a recession when the 3-month moving average of national unemployment rate rises by 0.5% percentage points or more relative to a minimum of 3-month averages, right? So basically, here you're looking at 3-month averages. So if you look at 3-month averages going up, you're talking about March, April, May. The reading comes out in about June. So you've got inflation, which should come down in May. This number, if it continues to increase, comes out in June. So again, we're talking around May, June, this market starts to turn, right? The next indicator, so remember, the first indicator was fear. The second indicator was inflation, which is a monthly. The third indicator was unemployment, which is a monthly, but actually the SARM rule is a 3-monthly or quarterly reading. The next reading is again a quarterly reading. And the quarterly reading here is the GDP data. And the reason why the GDP data is so important is because generally you look to GDP or the growth in GDP to tell you whether or not there's a recession. So they define a recession as 2 or more periods with negative GDP growth, right? So we're looking for negative GDP growth for 2 or more periods. Now, if you look at historical GDP, the last reading was 2.3%. The forecast now, or at least what the Atlanta Fed is telling us, is that GDP is going to go from 2.3% to negative 2.4%. That comes out in how many days? 19th. So on the 19th of March, we get the GDP reading, and we're expecting it to be negative for the first one. So that's 1 quarter of negative GDP growth, right? Now what you need to do is you need to work out, you need to get 2 quarters of negative GDP growth to make sure that you've got a recession, right? For Trump to be able to stand up and tell Powell, listen, buddy, you have to reduce rates. And the reason why you have to reduce rates is because we are in a recession. He can only say that when he's got 2 quarters of negative GDP growth. The first one comes out in a week. The next one comes out in 3 months, which is April, May, June. So now you've got inflation, which should turn in May. You got the SARM indicator, which should turn somewhere around May, June. And the next GDP reading comes out somewhere around June, and that will give us 2 quarters of negative growth if there are 2 quarters of negative growth. And so that puts the recession indicator in or around June. Now, as Fred Krueger says here, which I agree with, says the reason Bitcoin is going down is simple: fear of a recession. The only reason GDP and employment was holding up was because of massive government spending. But now the massive government spending is over. And so very soon the government will have to reduce rates to stimulate the economy again. And that's pretty much what's going to happen. So right now, as you look at the recession indicators, there's only a 20% chance. This is the market implied US recession probability. The market, when you look at all the indicators that are talking about a recession, the VIX, the S&P drawdown, the spreads, etc., you're talking about there's a 20% probability of a recession. That number needs to go up, and the US needs to go into a recession on paper, not a long-term recession, but the US needs to go into a recession on paper in order for the Fed to actually start reducing rates. The other thing that will start happening quarterly is the fact that companies are going to start to report their earnings. And what you want to see is you want to see their earnings coming down, and you want to see them blaming the economic environment. Now, the December earnings we've already had. The first quarter earnings, which is January to March, will start getting somewhere around April and May. And so what you'll start seeing, again, one of the indicators that we're looking for to trip is for company earnings to actually start coming down. And again, that becomes a quarterly. So you've got inflation, which is a monthly. You've got the jobs, which is a monthly, but the SARM indicator gives us once every 3 months. you've got the GDP numbers, which are quarterly, and then you've got earnings, which are quarterly. So what we're starting to see is that if all these numbers and all this data starts to play out, you're pretty much looking at the end of this somewhere around May and June, right? So that's more or less when the numbers will come out to give Trump the data to force Powell's hand to actually reduce rates and to start quantitative easing. And then from that point, we're then looking towards when will be the Fed meeting when we actually cut rates. So there's a meeting on the 18th of June. It's possible that it would be that one, but probably the bigger interest rate cuts will be somewhere around July. And you can see that the market's already expecting 2 interest rate cuts by July, with a 45.8% chance that there is also going to be a reading in July. And so everything's pointing to all this pain ending around June or July. One thing you must remember, though, is that Trump is not looking for a small cut in interest rates. I mean, it doesn't make a difference to him whether you refinance the debt at 4.5 or 4.25. Trump's looking to go from 4.5 all the way down to like 2%, so you can refinance the debt at like 2%. And so he's got to cause a lot of pain between now and June and July in order to force Powell's hand to reduce interest rates, not by 0.25 and 0.25. Trump's going to want a real reduction in interest rates. Now, one of the other metrics that points to exactly the same thing is this metric over here, and that's fear and greed, right? So if you look at the fear and greed, and you look at all the previous times where the fear and greed actually dropped below into extreme fear, so below 0, between 0 and 25, what you'll see is that in this, here it was 160 days, here it was 50 days, here it was 91 days, here it was 31 days, but we were very, very, very much in an up market. And here it was, we're currently 14 days under in extreme fear. Now, generally, when there's extreme fear, markets are low, and then when the markets go up, there becomes extreme greed. And so if you just look at the fear and greed, you can say that, look, on average, it takes about 90, we tend to bottom, we tend to get buying opportunities for about 90 days. So generally, when fear and greed goes down, it's between, 33 days and 160 days. And generally, if you look at it and you average it out, it looks like it's going to stay down for 90 days. March, April, May. And so you're starting to get this massive upturn around March, April, May, right? So everything kind of lines up with this market turning somewhere around May. Why? This plus the M2 money chart, which had about a 70-day lag, which I think I showed you that chart a few days ago. And so I think we agree now with, if we look at all of that, we then go back to actually looking at what Cathie Wood's saying. And Cathie Wood's saying, in our view, the marketing is discounting the last leg of a rolling recession, which will give the Trump administration and the Powell Fed many more degrees of freedom than investors expect, setting up the US economy for a deflationary boom in the second half of the year. So she's talking about the second half of the year, which is July, she's calling it setting up the US economy for a deflationary boom. And that's happening in the second half of the year. So all of these indicators kind of point to the fact that you have to have enough stamina and you have to be able to survive the time and pain approach for about 90 days. Literally, you have to count down 90 days. And within 90 days, generally, this fear should be, this should all be gone. Also, remember another thing, that markets are forward-looking vehicles. So if the market is expecting data to be good, then it will discount that and it will react before the data is actually good. So my guess is, if you want to prepare yourself for the pain, you need to prepare yourself for about 60, maybe 90 days of pain. But in this case, what I would say is rather start thinking about this not on a price-based approach, but actually start thinking about this on a time-based approach, right? So start thinking about your investments here. Start thinking about them. Don't worry how low they go. Just worry about how long you can sustain the pricing. If you hold Bitcoin, if you hold ETH, if you hold SOL, forget about the price and just make sure that you can hold for a long period of time. That's how I would play this. I would make sure that you are geared to hold your investments for a very long period of time and you forget about the price. I actually found myself yesterday, like, not really caring what the price of my altcoins was because I've kind of written them all off. Like my meme coins are worth zero. My AI agents are worth zero. My Solana, well, you know what? I know it's going to recover at some point. So I'm not exactly in a price-based approach. I don't really care how low it goes. I'm more in a time-based approach. And that's how I would do this. I would gear up for the long haul. And the long haul to me says we'll probably be out of this in 90 days. And so you need to survive the next 90 days. And I don't actually think that you need to survive the next 90 days. But I think you need to realize where we're at for the next 90 days. So the first thing is, I think it's too late to short. I think if you're shorting now, you're taking a chance that maybe we won't go low enough to justify being able to short. Also, you're taking a chance that maybe we get some kind of crazy bounce and you'll get liquidated on your short. So probably too late to short. Someone says maybe too early too long. Now, I don't know if it's too early too long, to be honest. I think that you should start longing when you see deals. I mean, I started buying Tesla yesterday. Maybe it was a little bit too early to buy Tesla. But the truth is, I think what you do now in the next 60 to 90 days will really dictate whether or not you're going to land up making money in the cycle. Why? Because only idiots were out buying the top. And this is the best time to actually be engaged in the market, to actually be farming for great deals. I mean, just look at these deals, okay? So like, you look at Solana, or you look at Tesla. You've gone all the way back to 2021. You look at Solana. Like you've literally, if you're buying Sol now, you're buying Sol at the same price that it was a year ago before all the meme coin hype. That's literally the same price that you're buying Solana at. And so you've literally rewound prices for over a year. Like in most cases, prices have been so badly nuked that we've gone to levels that are lower than they were a year ago. And so you've got this amazing, amazing, amazing opportunity. Now, look, there's going to be more pain. And you need to brace yourself for more pain. And I think the way to brace yourself for more pain is forget about the price. Just worry about being able to survive from a time point of view. Make sure you've got all the cash to fulfill all your obligations from a pain point of view, right? Arthur Hay says, listen, we could go down to 70,000. He says that's a 36% correction from the 110, which can happen. We get SPX and NDX, which is a NASDAQ and the S&P 500 into a free fall. And then we get the Fed, the PBOC, the ECB all easing on their countries. And then that is when you're going to land up making money. But you're only going to land up making money if you're actually buying in this part of the cycle, right? If you still got cash. Tell you one guy who has got cash is Warren Buffett. I mean, the guy's got $334 billion worth of cash. This was actually announced in February. How did this guy actually know that in March markets were going to crash? He's sitting on $334 billion worth of cash. Unfortunately, unlike in crypto, no one's tracking his wallet, so you don't know when he's actually deploying the cash, right? You just see that Warren Buffett is heavy on cash, so you can't really see when he's deploying it. Unfortunately, maybe in time when everything's on the blockchain, you'll be able to see when Warren Buffett's deploying the cash. But this guy's sitting on a whole lot of cash, and as Luke Belmar says, he says, if you're bearish now, it's too late. Everything's already nuked 50%. You're not allowed to be bearish now. This is the time of max pain and time to accumulate winners. And I know it feels crazy. Like sometimes I don't feel like doing a show. To be honest, I'll be honest. Like sometimes I don't even feel like looking at my portfolio. And I have terrible ADD. So sometimes I find myself looking at my portfolio, but almost like not wanting the pain of looking at the portfolio. But I keep centering myself and I keep saying to myself, this is when champions are made. This is when you've got to take the tough portfolio decisions. You got to look at your losers. Your losers are the worst tokens in your portfolio. When you look at them, you feel like you literally feel like vomiting, right? Like you look at them, you go, cannot believe I was so stupid to buy. Like, I mean, I'll show you some of the charts that I hold. I'm not embarrassed about it. I should be, but I'm not. Let me show you one. Cerebro, right? You guys seen this chart? Have you ever seen a chart like that? You ever seen a chart like that? Yeah, now the truth is you got to look at this chart and you got to say to yourself, like, am I going to hold this or am I actually going to trade this? And am I going to trade this into something that goes up in the next cycle? So this is what you need to do right now. And you need to switch out of all your garbage and you need to make sure that you're holding the right tokens that are going to take you into the next thing. And you've got to do this now because there may still be some downside. And if you don't do it now, you may ride this thing. I mean, I don't know. Can it go below zero? I don't think it can go below zero, right? It's impossible to go below zero, right? Yeah. So There's a lot of these. And I know you're holding them too, because I think we bought them all together, right? You need to now spend the time on your portfolio and realign your portfolio. That's one of the things that you really, really, really need to do right now. Because the moves that you make right now are the moves that are going to decide whether or not you'll end up making money in the cycle. Remember, there's going to be pain. There's going to be a lot of pain. And maybe Bitcoin's going to go to 70,000. And if Bitcoin does go to 70,000, the alts are going to get absolutely fucking destroyed. Specifically, if you look at alts like ETH, right? ETH got a double whammy of a problem. It's getting destroyed. But also because DeFi sits on ETH, the problem is that there's on-chain liquidations. So all these people that have put up ETH as collateral to take loans on DeFi chain, problem is they're all getting liquidated. So yesterday there was like this massive liquidation of like, was it $100 million worth of ETH? $100 million worth of ETH yesterday was getting liquidated on chain because the guy, just send me there's like a tweet about this guy who went AWOL. And so in this time, what you're going to get is you're going to get a lot more pain and you're going to get a whole lot more liquidations. And liquidations cause liquidations, right? Because as liquidations happen, they smash the price and then there's more liquidations. So you have to be smart now. You have to be like super, super, super smart and say, forget about the price. Don't look at the price. Just make sure you can survive the time. Just make sure you can survive the time. Just make sure you can survive. Think David, what's his name? David Goggins. Just think David Goggins. Just think David Goggins all the time. Survive, survive, survive. Just keep running. Just keep running. Think David Goggins. Think, what's his Finding Nemo? Just keep swimming. Just keep swimming. You don't have kids, right? Just keep swimming. Just keep that. You just go, just keep swimming. Just keep swimming. That's all you need to do. Because in 90 days, this is over and the markets recover. I've got no doubt that the markets land up recovering. Trump didn't come into office to crash markets. It's all a very, 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 very calculated move. I'll tell you that much. So you need to make sure that you survive and you need to make sure that you're making the portfolio moves today. Today, don't delay because tomorrow it could be 50% down. And if they recover, I'm not asking you to sell and go into cash. I'm saying just move your tokens from one token that you think is not going to recover to another token that is actually going to recover. That's it. And then forget about your portfolio. And the reason why I say that is because we were all holding shit. And the problem is that if you don't look, if you adopt the ostrich approach and you put your head in the sand, you say, I'm not looking at my portfolio, I'm not looking at my portfolio. The problem is that your bad tokens are going down. So you need to look at your portfolio. You need to be completely focused. And you need to create a portfolio that you're happy to take into the next part of the cycle, and then you just need to survive the next 90 days. That's it. That is all, literally all you need to do, believe it or not. Except there's one other thing that you need to do. One other thing that is super, super, super important that you do. So, hear me out here, right? I don't know how much money you've lost, right? I've lost a ton of cash. A ton of cash. I mean, I've lost so much cash that it really, really, really hurts. That it's bad. And to be honest, I think it's okay if you land up losing cash when you're investing. It's not nice, but it is like okay. Because we know the risks, or we're supposed to know the risks when we actually land up investing. The one place that you cannot lose cash is through wallet drainages, right? Promise me you're going to do this. Just promise me you're going to do this, right? There are sites that look like normal sites, and when you click on them, they've got code, and that code is designed to effectively crash or drain your wallet. But we have a partner on the channel, and this partner on the channel is called Kerberus. And what this actually does is it's a Chrome extension. You press this button, you download the Chrome extension. It reads the code of the actual website, and it makes sure that you cannot get drained both on EVM and on Solana. So it reads the code of the website, says, this website's got a draining, and it won't let you access your wallet. It's an extension that you can install for free. They make their money by taking a very small percentage on certain DEX trades, right? You need to install this and to make sure that you're not actually drained. Now, remember Bybit got hacked? And now they're all about security. Well, we've managed to get some money from Bybit to do a giveaway, right? So anyone that installs the Kerberus link, that installs the Kerberus Chrome extension using this link, we will then give away $5,000 to people over the course of this week, to anyone that does it. Just go and do it. Click this link over here. Okay, sign up with this link over here. If you're on your mobile phones, just when you get home, because this is not for mobile phones, because it's for your web browser. Download it, and you can stand a chance of actually winning $5,000. Also, I want to remind you, it's Eric Crown School. You got 6 days left to sign up to one of the best schools, and the next time it's going to be $2,000. So hurry up and do it. Anyway, I will see you guys again tomorrow. And when I come back tomorrow, there'll be 89 days left of the shit. And then we're going to Valhalla. See you again tomorrow. Until then, trade well, my friends.